Welcome to our learning module for week 6. This week we're going to talk about managing supply, and this will be closer topically to what a lot of students come into the course thinking supply chain management is all about. We've learned that supply chain management is the whole breadth of activities from raw materials all the way till a consumer takes possession of a good or a service. But this section, this particular chapter and discussion this week is really closer to how a firm manages its direct suppliers. Okay, and for the most part, we'll focus around a manufacturing topic, the manufacturing approach. We'll think about complex industries and how that's accomplished. So let's move forward here. Excuse me while I mouse my way over. Okay, so the module objectives, you should be able to discuss the rise of supply chain management or supply management as a practice, and that many more firms are seeing it as a strategic function, taking different functional areas such as logistics, plant purchasing, overall higher level purchasing of commodities across the company, project purchasing, and are looking at those as areas that they can consolidate and get more value out of. So there's a rise overall in supply management as a function in organization. There's more jobs, more management jobs, and so forth available every year in this area. We're also going to talk about global sourcing and how globalization of business brings global sourcing along with it. We'll look at some organization and functions so that you get a feel for how a global sourcing organization might look, how it might operate, some typical structure. We will calculate some important financial measures. So what you'll see is the impact that sourcing has and supply management has on a company's bottom line. We'll look at a couple ways to measure that, such as the profit margin, the return on assets. The strategic sourcing process we're going to look at in 6 steps. And you'll be familiar then with how an organization could start with maybe low structure and low strategy, and how they might perform some analysis and make sense of their whole sourcing opportunities, put some structure into it, and get more value out of sourcing by taking a strategic and structured approach. We will look at an example of a purchasing category, steel, because I want the class to get a feel for a very pragmatic look at, well, what happens inside some of these commodities. Sometimes we buy highly sophisticated engineered products. Sometimes we just buy a commodity. They're very different. And I'm going to give you a look at steel, just to give you a peek into that world. And we'll talk about some of the long-term trends in supply management and why those trends are important. So supply management, it's a good definition here. The broad set of activities carried out by an organization, by organizations, to analyze sourcing opportunities, develop sourcing strategies, select suppliers, and carry out all the activities required to procure goods and services on an ongoing basis. It's a pretty broad topic. Why is supply management so important? Well, if you look at this chart, you'll see that out of 1, 2, 3, 4, 5, and a consolidated 6th, out of 5 out of 6 major categories here that were selected, and I think they picked one just to show not everybody's in on it, the cost of material as a percentage of a dollar sold is rising. So that means the bill of materials, the cost of purchased goods, are taking up more and more and more of a dollar's worth of sales. This is in percentages, so you can think of it as pennies on the dollar. In 1997, we see 53.5% of food has moved by 2011 to 63.1%. That's a full 10% increase in the cost of the material. 46 in chemicals has moved to 52. There's a 7% roughly increase, right? 46.2, but 6.5. Plastics and rubber gone from 49% to 55.8, almost 7% increase. Computers and electronics, it dropped. So we do have an exception on the chart here just to make the case that, well, of course, everything is never black and white. Some things have gone down in material costs due to competitiveness, innovation, etc. Transportation equipment, gone up slightly, a couple percent. But for all manufacturers, we see a 52.5 to a 59.1% increase. That's a significant impact if you think about running a business, trying to earn, of course, the best profit you can for yourself if you're the owner, for the shareholders if you're a professional manager. Your job is to grow the business, serve your customers, and earn a profit. We are in a capitalist system, so we can never forget about that profit. It becomes more difficult when year after year, your cost of materials continues to increase. So this makes supply management a very important function of the business. If we think of a couple of key examples of the financial impact, we can talk about cost of goods sold. This is a term you should remember. Cost of goods sold, or COGS, capital COGS, it's the purchased cost of goods from outside suppliers. So when you see a roll-up, a financial statement, an income statement, usually you'll see cost of goods sold for any manufacturing company. And that's part of the standard accounting terminology, right? Accounting standards would very much define cost of goods sold. So the purchased cost of goods from outside suppliers, merchandise inventory. So that's a balance sheet item that shows the amount a particular company paid for the inventory it has on hand at a particular point in time. It's very important to remember from your financial class, and if you didn't take that yet and you don't know these terms, the financial statements consist of an income statement, and that's where we, for a period of time, take what we've purchased and what we've sold and what our expenses are and decide the bottom line. We can see the bottom line if we earned or lost money for that period. Usually it starts with the top line, which is sales or revenue. It's the same thing, sales or revenue, right? So money coming in, what did we sell this month is the top line, the big number, and then we deduct all the expenses to get to the bottom line. What did we get to keep? What was the profit? So cost of goods sold is a major entry on that income statement because as we just saw, it's 59% of the top line. And in some companies, it's more, right? Some more, some less. Merchandise inventory is on the balance sheet. The balance sheet doesn't represent a period of time. It represents a snapshot. It's a picture of the financial health of the company, some key ratios, bank accounts, assets, liabilities, shareholders' equity, and it shows us a situation at a particular moment, at month end, for example, at year end, at quarter end. But it doesn't represent all the activity of the quarter. It represents a snapshot in time that tells us where we are with our assets and our liabilities. So the balance sheet item is merchandise inventory that we would think of from supply, the key thing we're going to look at in the next few slides. That means how much inventory do we have tied up in our operation at this moment in time that the balance sheet represents. So we'll just say it's month end. It could be year end, could be quarter end. It's a point in time. The more we pay for inventory, the more we pay for our goods, the more money is tied up by our inventory balance. The profit margin is just the ratio of earnings, our profits, to sales for a given time period. So if we sell $100 and we earn $5 divided by 100 is 5% profit margin. The return on assets, it's simply a measure of that profit, that $5 in the other example in the profit margin, that $5 over our asset structure. So companies are concerned about what is our profitability on our assets because you don't like to have idle assets or unproductive assets in your company, or you're tying up too much capital in your business, too much money in your business. Okay, so we're going to look now at how these come together and make supply management very important to the profitability of the company. So for every dollar saved in purchasing, we lower cost of goods sold by $1, and we increase pre-tax profit by $1. What does that mean? It's real simple, right? You can do it for a lemonade stand, or you can do it for one of the biggest corporations in the world. If we spend an additional $1 on our materials, that money goes from our pocket to our supplier's pocket. The game never ends of who gets that $1, right? That's the perpetual game inside the game that goes on every day when we buy and sell products. That haggle and negotiation and attempt to get that $1, right? So for every $1 we lower our cost, we will increase profit by $1. Every $1 saved in purchasing also lowers the merchandise inventory figure, and as a result reduces total assets by $1. So if we purchased a device, we purchased a stapler, right? That's not a good inventory item, but let's pretend it is. All right, so if we purchased this and it was a $10 cost, and we went to our supplier and got it for $9, two things would happen, right? When we resold this, we would earn another $1. We've improved our profits by $1. We're assuming selling price stays the same. We just had a purchasing victory. And our inventory in the back, in our warehouse, of 10,000 of these things, right, is reduced by that $1, right, which is 10% of the $10. So our inventory value, our asset of inventory, is now not, okay, if we have 1,000 of these staplers out back, that would have been $10,000 in assets yesterday. But when we convert over to the new price, it's $9,000 in assets. So two things happened here, and we're going to do the math on it. But I'm giving you a preliminary so you can start turning around in your head. We've improved our profit margin by $1 every time we sell a stapler on the income statement. We've improved our ratio of our return on assets on the balance sheet by saying every time we earn that extra $1 in our profitability, our profit margin has gone up and our asset base has gone down, which is a good thing, right? So we've improved both of those ratios. There's one third thing I need to describe to you here before we go to the example. It's called the profit leverage effect. This is a term used to describe the effect of $1 in cost savings, increasing pre-tax profits by $1, and the $1 increase in sales, increasing pre-tax profits only by $1 multiplied times the pre-tax margin. All right, so the key point to understand here, and we'll do a little math on it, but you need to understand the profit leverage effect. It means simply, think of it, if we saved our $1 here, and we already talked about every time we sell one of these, we're going to earn another $1, right? That we get the whole $1. If we sell an additional $1 worth of staplers, though, it doesn't drive us that full profitability ratio, right? We need to do exponentially a number of higher of sales numbers to get the same amount of savings that we would out of a cost reduction. Because we get all of the cost reduction, we only get the profit margin on the increase in sales. We'll do a little math and you'll understand it. If that didn't completely get you, you're going to completely get it here before we're done. Okay, so here is an example from the book, example 7-1, Target Corporation, of some of these financial impacts. So we have sales, $65,786. We have cost of goods sold, $45,725, giving us a pre-tax earning of $4,629. That's on our income statement. We have a balance sheet, a couple of selected items from the balance sheet here. We have our inventory, $75,096, and we have our total assets, because we have other assets other than inventory, right? We have lots of different assets. So the important thing to remember there is that this merchandise inventory is part of your assets, right? As we go through these, remember that this is an asset. It's just a part of this number. So our profit margin would be found as 100% times earnings divided by sales. So 65,000 46,729 divided by 65,786, as we see right here, is a 7% profit margin. Profit margin is almost always expressed as a percentage. We can talk about profits in dollars. We can talk about profit margin as a percentage. Our assets here, if we want to do our return on assets, right, is our profit margin of 46.29 divided by our total assets, 17,213, which is a 26.9% return on assets for this period of time that these items represent. Let's look at what would happen now if we were to take Target Corporation and perform a hypothetical 3% purchasing cost reduction. So a reduction of our cost of goods sold by 3%. So we'd go to our sales and we'd say they're not affected. We didn't talk about a change in sales dollars. So assuming stability on the sales side, piece price remains the same, volume remains the same. What is the effect of this 3% reduction in cost of goods sold? We would simply take our 45,725, right, and multiply it times 0.97 and take that difference, right, or multiply it by times 0.03 and do the subtraction, get there either way you want, and we would get to a reduction of 1372. That's the 3%, giving us a new cost of goods sold of 44,353. So just 45,725 minus the 3% equals 44,353. And pre-tax earnings, we would add in that dollar for every time it occurred, right? So remember what we mentioned in the prior slides. Every dollar saved in cost of goods sold is directly dropped into our profits. Okay, so that's pretty simple math, and I think easy to understand. The selected balance sheet items that we're looking at now. So if we reduced our cost of goods by that 3%, then we've reduced the value of the inventory that we buy, right, on the shelf by $73.68. Now, of course, if you could get into it and say, well, not until we purge all the old inventory, but this is simplified for the discussion just to say, let's assume we sold all that yesterday and now we have new stock. So we decrease by 3% by that price decrease, and we get $228 lower merchandise value on the shelf, reducing our assets by the same amount, that $228 of our total assets. Let's look at the profit margin impact. So 46.29 divided by 76, we already looked at this, right? This was a 7% profit margin. But what do we have now? We still have our sales identical, but we have a new profitability number. So 6,001 divided by 75,786 is a 9.1% profit margin. That's a nice increase. That's a very nice increase. Somebody's going to be happy about that, right? The return on assets impact. So before any change, we had our 26.9% as calculated on the prior slide. Now we have the 6,001, a higher number for profits, and we have a lower number for the assets, right? 17,213 is now 16,985. This number went down because of our lower cost structure. So our return on assets is now 35.3%. So these are two key ratios among many. When you have your financial accounting class, your managerial accounting class, you go through a lot of ratios. But you will remember when you go through that, you'll say, oh yeah, we looked at this in the operations course. So you see here a couple of the really key contributors of purchasing to the financial, directly dropping into the financial well-being of the company. Let's talk through now this profit leverage effect, because it's a very important concept, and all business people should understand this concept. So what sales increase would have the same profit impact as this 3% reduction in cost of goods sold? So let's just assume the management team thought they were going to get the money out of the supply base. We've been told by our board of directors that we've got to hit this 9.1% profit margin or our jobs are on the line, right? And the suppliers all said, no dice, no way, ain't happening, right? And we didn't get any of that money. Well, everybody's eyes turn over to the sales team, right? And say, we're going to have to sell more. We're going to have to sell more. And we need to figure out how much more we need to sell to get this amount of money. We won't get the profit margin impact, but to get the total profitability impact, right, of that we would have gotten out of this cost reduction that we failed to achieve with the suppliers. So in other words, we want this 1372. We want to chase that 1372. We're not going to get it out of the suppliers. Put an X here. We got to get it out of sales. How much more do we need to sell to get that 1372? It's very simple. You just take your profitability in your percentage, your 0.07, your 7%, right? These margins that we calculated up here. And you say, okay, if that's going to remain the same, how much more do I need to sell to get that 1372? And the simple answer is you take $1 and you divide it by the 0.07, and that gets you about $15, right? 1 divided by 0.07 is $14.28. So we need $14.28 for every dollar here and tied up here. For every dollar of profitability increase, we've got to sell $14.28.5. You can do that division yourself to see it if you like. So we would take the 1 divided by the 0.07 to give us that multiplier, and then we would multiply that times the 1372 that we want. And we'd come up with this $19,599 increase in sales to have the same impact on profits as a 3% decrease in cost of goods sold. And that is really just to let that burn into your learning. What we're just talking about here is saying we only get 7 cents. We only get to keep 7 cents on every dollar we sold. So if we want $1, we got to sell 14. If we want to earn $1, we got to sell $14.50 if our profit margin is 7%. As the 7% moves up or down, becomes a different number, it's a different multiplier. That's the profit leverage effect, and that is how to solve that question. Remember that it's $1 divided by the profit margin in place, and then times the gain that you want, and then you know how much sales you want, a much bigger number than the gain that you have to achieve, right? The gain in profits.